Since 2016 is the year of the monkey, it's certainly appropriate that China is the 600-pound gorilla, both in terms of the world economy and especially in terms of shipping. But this ape is not very happy. I think maybe he had some bad bananas for lunch. We've stated for a few years that the actual growth in China has declined a lot, and we think is now at best 4% or so, despite government's claims of higher growth rates. Interestingly, the Anti-Corruption Commission is now investigating the head of the country's statistics agency. My guess is that he'll be purged as the official data are revised downward closer to our estimates. But why is growth slowing? China is no longer the cheapest place to manufacture or assemble products. Wages have risen faster than in other emerging markets, and so has the currency. Most emerging currencies have gone down, not up. Second, huge capital expenditures have built ghost cities and excess industrial capacity, and therefore easing monetary policy is not going to necessarily produce more capital spending. For example, steel has expanded its capacity in China to 1,017 million tons, half the world's capacity. China last year had internal consumption of only 700 million tons, so they exported, mostly dumping, over 100 million tons in other markets, principally US and Europe. And even with that, they were only operating at about 80% of capacity. Their 200 million ton excess capacity is greater than the total US consumption, and similar situations prevail in many other basic industries. China's dumping, however, has caused countervailing tariffs all around the world. For example, in the EU, dumping of Chinese steel has cost 40,000 jobs already. So the EU will continue to impose additional tariffs, and so will the US. Those have been gradually coming in as the trade cases are decided. So some portion of China's 108 million tons of steel exports, virtually all by sea, are at risk. So therefore, are there imports of iron ore. Potentially offsetting any export decline is the fact that Chinese iron ore inventories were reduced by 30 million tons last year, thereby restraining imports to about 80. But the mix of the Chinese economy is changing from capital investment and export-led to service industry and consumer demand-driven. As a result, steel intensity and generally raw material intensity of the economy is declining. Steel had been 16 cents per dollar of GDP in 2014, dropped to 14 cents per dollar last year, and is probably going to be down as low as 12 cents by 2017. Therefore, domestic steel demand may well decline by as much as 2% again this year. Putting all of these variables together, it's hard to see much increase in Chinese demand for steel-related bulk shipping. China also imported 115 million tons of coal and lignite last year. The domestic production in China is high cost, low quality, very pollutive, and lost 95 billion RMB last year. But so far, the government has not followed through on promises to shut these facilities. So Chinese dry bulk imports fell 6% last year, mostly because coal imports dropped by 29%, but Indian bulk demand rose by 8%, partially offsetting that. Even more complex than dry bulk demand is the supply side. At the start of 2015, dry bulk order book was 85 million deadweight tons, but 11 million were canceled and 12 million were delayed to 2016. Yet DNB forecast 10.8 million deadweight tons of orders in 16 and 12 million in 17. Dry bulk rates, as you know, are the lowest in about 30 years, and scrap prices are relatively high, so you might expect a lot of scrappage. For example, the Panamax scrap value is around $5.5 million versus a recession low of $3.8 million. And indeed, the average age of scrap vessels did decline last year, but still was quite high, 28.7 years for Handysize, 22.7 for Panamax, and 20.9 for Capesize. In 2016, 2.7% of the dry bulk fleet is due for its third renewal survey, and 1.7% for the fourth, but only 0.4% for the fifth. In 2017, the figures are respectively 1.9%, 2.0%, and 0.64. These are not powerful drivers of scrappage. Therefore, it will probably only be around 2.5% both in 2016 and 2017, far below estimated deliveries of around 9% in each rates in 2016 or 17 for dry bulk. A very different story is China's dominance of crude oil and petroleum product shipping. It's almost as important a factor there as it is in dry bulk, but China has been and will continue to be far more supportive of these liquid cargoes than of dry bulk. Oil imports grew 8.8% year over year in 2015, mostly for transportation end use, and this sector continues to grow rapidly. The reason is that Chinese bought 24 million new vehicles last year, a 9.4% increase in the previously outstanding fleet of 253 million, and air travel miles expanded also by more than 10%. Similar increments to both are forecast for this year. In addition, China added to its strategic petroleum reserves last year and plans further increases through 2020 until reserves equal 90 days of consumption. Even more interestingly, China has become a net exporter of petroleum products. Refineries there processed 10.8 million barrels per day on average last year, up 28% year over year. In November, net exports were 6.8 million barrels, and in December, net exports were 9.3 million. This is good news for both crude and product tankers because essentially all the crude comes in on tankers and the exports go back out on product tankers. A similar phenomenon is occurring in India. More refining capacity will come on stream in both for the next few years. Meanwhile, in terms of both crude and refined products, U.S. demand for imports has been strong. Our imports of gasoline, for example, rose by 20% in 2015, because miles driven increased sharply as gasoline prices declined, and people also bought larger, less fuel-efficient vehicles. Since gas prices have recently dropped below $2 a gallon in many places in the U.S., there likely will be further price elasticity of demand. And given the high operating rates of U.S. refineries, this incremental demand will have to be met by imports. Similarly, U.S. production of crude is finally starting to decline, and therefore our net imports will increase even further. Meanwhile, the almost 300 million barrel rise in OECD oil inventories last year from slightly more than 2.7 billion barrels to almost 3 billion will decelerate to an addition of about 40 million barrels this year, according to the IEA. I must point out, though, that in December 2014, IEA had forecast that 2015 inventories would rise only by 30 million barrels, not the 300 million that they actually rose by. So their forecast may be too optimistic again. Nonetheless, we're into uncharted territories for inventory, and this has prompted recurring rumors that limits on existing conventional storage will result in huge demand for floating storage. No one really knows the full extent of conventional storage, but we do know that floating has ranged between 150 million and 180 million barrels during 2015, the capacity equivalent of 75 to 90 VLCCs. Until Iran's oil expansion is absorbed and until inventories drop to more normal levels, we believe that oil prices will remain low, probably through this year and into 17. That will mean continued good supply, but there will be periodic periods of excess supply due to the bunching of deliveries. So though tanker rates may slip a bit in the next year or two, overall the environment should be excellent. Whether it goes on for longer than that depends largely on whether tanker owners have finally learned that all of us would be better off by not going on a new buying binge just because rates have been strong for a year or so. The only real danger ship owners face is their tendency to overorder. And in fact, the math of new building doesn't really work very well in today's market. If you assume even a small decrease in time charter equivalent as a result of your own ordering and that of others in the industry. Based on recent potent tanker data, if you had 10 Suezmaxes and added one more, and the combined effect of the industry's orders, including yours, were just a $2,500 drop in time charter equivalent, your net cash flow would actually decline from about $57.8 million to $53.9 million, even though you would have committed another 60-odd million to the fleet. And it's not rational to believe that only you alone will order more vessels. And I would suggest that to change time charter equivalents by $2,500 a day doesn't take more than the slightest supply-demand imbalance. Unless rates were vastly higher than today, and ordering another Suezmax is nuts. This is especially true right now. The world is in its 7th year of recovery from a recession and is struggling to avoid slipping back. 18 months from now, when vessel orders placed today would be launched, the odds of the fragile developing and developed economies hitting a weak spot are high. Last time around, the new eco-demands provided a reason, or at least an excuse, for a new building, because bunker costs were so high. This is no longer true. Anyone who has a burning desire to put more money into shipping would do far better to invest in the stocks at discounts from NAV than to order new vessels themselves. Thank you very much. I now have time for maybe 2 or 3 questions. We do have time for maybe 2 questions. Is there anything burning?
Well, I wanted to say thank you for a great presentation, and also I find it particularly intriguing that you mentioned that it's better to buy shares in listed companies at huge discounts to NAV rather than investing in the assets themselves, because a number of industry experts right now, the analysts in particular, they claim exactly the opposite. Don't buy shares, buy assets. So I'm gratified to hear your remark.
I think I've always felt that to buy a dollar bill for 75 or 80 cents is better than to buy it for $1. Well, thank you. You're letting me off light on the cup. One more question. I thought I could escape.
Thank you for your remarks. They were very interesting. I wonder if you would speak to your thoughts on the current supply side of the crude shipping. I really appreciate your comments on the bulk supply, but I would like to know more about the crude side. What do you think about what's in the current order book?
There are more Suezmaxes coming in the latter part of this year than I would really prefer. So there is some little bit of danger of oversupply, I think. Whether some of those will get pushed out into 17, I don't know. But certainly you can't argue that Suezmaxes are in unduly tight condition. And I think it's even a little hard to argue that with the VLCCs. So that's the other reason I don't see any great urgency for people to be ordering new vessels. Makes no great sense to me to do so. And so we are not. We would be buyers of the equities rather than buyers of the vessels at this point. And when you think about it, even though rates have been pretty good for VLCC and pretty good for Suezmax, the actual resale value of the ships has not been particularly good in the last year or so. So the public stocks are trading at discounts from what we view as relatively low net asset values. So you have kind of a compounding of discounts on top of each other. Well, thank you. We're out of time, and I know Nicholas wants to be on schedule. Well, Capital Link is a very useful conference because it brings together Greek investors, Greek ship owners, and international investors and international ship owners. So it performs a very valuable function. Right now, many segments of shipping have been depressed, particularly the dry bulk and the container space. Unfortunately, we think those will continue to have problems. The liquid space, VLCC, Suezmax, and product tankers seems in much better shape, although in some cases there's quite a bit of capacity coming in toward the end of this year. So while rates may go down a bit, we think the liquid side will continue basically pretty good.